Well, Dylan, I guess it's you and me.
We're missing our host. We're
Don't know what
befuddled
happened there.
and confused as the two panelists. As the two panelists awaited our host, who now apparently is gone missing.
This is my virgin endeavor on this show, and that threw me. So hi.
So the only question is, do you have the ability to control the charts and the screens? I bet you don't.
Not even in the slightest bit. No. So it's gonna be a lot of talking until Chris figures out exactly what he did wrong.
Well, it's a pleasure to see you in public for the first time.
Yeah, I mean, this is actually the first. This is the first time we've ever been on air together, and we've been working together since 2020, I believe.
I mean, longer than that.
Since the 2020 election. Yeah, maybe, but I do know. I remember the 2020 election. Doing a bunch of stuff for that. So, I see. Mr. Vecchio has rejoined us. If that was
I guess I'm back.
Chris, well played.
Yeah, good.
Appreciated that.
Yeah, no, not my intent. You got to love when the internet just flashes off here. I'm assuming that we're live and you guys are talking about the Google earnings that have just come out.
Well, we were just actually talking. We were waiting for you to arrive to tell us about the Google earnings because we don't have the ability to show the charts. So please tell us what's going on.
Well, for those that are here, I suppose, welcome to the show. Josh sitting in for Ilya today, as he's previously explained. We have a market that's closing up here at all-time highs, and Google earnings are out, and they are better than expected. Google's beating EPS 231 versus 218. Expected revenues were higher, 96.43 billion versus 93.97 billion expected. Their cloud revenues, that's where people hide the AI, those are up 13.62 billion versus 13.14 billion. Here's where some of the numbers get funky. CapEx was up at 85 billion versus an estimate of 73.31. So Google down here slightly after hours. We were looking at a chart that was closer to 190 prior to the release. We touched a high just short of 196. We're now back down to 185. But let's go around the horn here as we look at this market, which an S&P closes up near all-time highs today. We tagged 6,400 right around the close here in ESU5. The NASDAQ lagging a little bit, but still strong, up 0.5%. The leader in today's session is the Russell 2000, up 1.46%. Buttressed by the good news that we have some trade deals coming down the pipeline. Last night, Trump announced that Japan and the U.S. have agreed to reduce Japan's tariffs on the U.S. to 0%. The U.S. will be employing 15% tariffs the other way. With the EU, Financial Times reported today that a 15% tariff rate across the board is coming down the pipeline. So markets, good news is good news. We're not going to get the worst of it come August 1st. So much for those fear Mr. Radigan. But I will say that bond yields were higher on the day, and the dollar was weaker, not benefiting from them. And that kind of throws me for a curveball for the sell-off in gold and pullback in silver related to the trade wars potentially coming to an end. I digress, though. We have a lot to cover here in today's show, and we have a new guest, Josh Fabian, who does not come on air all that often, but we had a need, and he raised his hand. So thank you, sir, for joining us in today's session. Dylan, you are the relentless bull around here, though, and you're the only one who's been leaning long stocks. So with that said, what's going right for this market that apparently I was clutching my britches over?
I mean, what's going wrong, I think, is the question. I think the what's going right is that everything the market is afraid of tends to be an illusion. I'm saying specifically with the tariffs and the economy, as evidenced by the earnings, is as strong as ever, and inflation is a basically known at this point. It's priced in. Tariffs are a known discounted item that's going to be less and less relevant as things move forward, and the relative economic strength is high, and the liabilities of the American presidency are being worn in the currency. They're not being worn in the financial markets. So I just don't see why the financial markets, the stock market, the equities market doesn't continue to perform.
Josh, this is a market that's going up to new highs here. I'm waiting for those IBM and those Tesla earnings as well. So if anyone sees those having come out, please let me no here. I just said that, and they literally just popped up on my screen. So the devil listens sometimes.
Tesla or IBM?
IBM, EPS at 231. So let me just pull this up on the screen here, in fact, before I start talking about it. At IBM out here, I would argue that it's looking a little bit soft.
Doesn't look good. Doesn't look good, Dylan, Mr. Optimist.
Let me find some of the deeper numbers here, though, because I want to see these flash across the screen.
IBM, I don't care about IBM.
Well, 231 versus 265 expected on the EPS, but Dylan, it's still a company that makes $17 billion a quarter.
I know, but it's not a bellwether for anything. It doesn't indicate anything.
Oh, okay.
Talk to me about Google. Talk to me about Tesla. Talk to me about Meta.
It's not part of the modern economy. I'll grant you it's not part of the zeitgeist anymore. But
all right, so go ahead.
Go ahead, Chris. No, I was going to say that you have the S&P trading at, I believe, about 22 times forward earnings, if I'm not mistaken, which is well above the 10 and 5-year average. So this market is priced for perfection. And I think you saw the ramifications of that last Friday when Netflix came out, and, by all accounts, it was a stellar report, and the stock sold off by 5%. So I think that, this market was giving you a hint then. It was a little bit frothy. And if you wanted any more evidence of its frothiness, you got back into this meme mania this week with, Kohl's. And yeah, that Kohl's taking off, Krispy Kreme. So I think that this market is starting to get out over its skis, maybe just a little bit, and say what you want about the trade deals that are all of a sudden coming to fruition. We're still, even at 15% on a lot of these deals, still 15% more than what we were at in January. There's inflation that's bubbling beneath the surface. There's structural damage in the job market. We're seeing even the jobs that are being created. If you just peel back the layers a little bit, you're seeing these jobs are in government, they're in education, they're in healthcare. And by healthcare, I mean like home healthcare. It's not innovative jobs. So
sorry, Tesla. Let me cut you off there for a quick second. Tesla earnings just came out. EPS misses at 40 cents versus 42 cents expected. Their revenues were still $22.5 billion versus an estimated $22.64 billion. So small misses, but stock trading up here after hours because, again, Dylan, as we've covered here on the show in recent days, this has been so beaten down sentiment-wise. My own personal bias, as long as the company remains a going concern and it's not shutting its doors, it probably has a big discount attached to it, given recent events around Musk et al. Either way, though, Tesla EPS, again, slight miss here. Slight miss, 40 cents versus 42 cents expected, but stock trading higher here after hours right now. Josh, you were saying before I interrupted you.
Just that, you have these macroeconomic issues that, need to be considered. But turning to Tesla really fast, I'm interested in what they have to say. I think the risk here is that this brand has been politicized, and was it the investor disclosure risk or first time investor disclosure risk for SpaceX?
Yes, that came out yesterday.
That they acknowledge that Elon could potentially return to politics, which I've never heard of that before in a disclosure risk for a company. So that really caught my attention. So I think that, there's some questions about this company, and let's see what they have to say on their conference call. What he specifically has to say on this call. I think that people want to hear that he's dedicated to this company. Not only that, but also what are the implications going to be for the lost subsidies moving forward?
Sure. Tesla here. I know that we had Mr. Westwater that was still leaning long vis-a-vis the short put spreads in Tesla. Those would be working out well. Dylan, other side of these earnings, obviously we want to hear what Musk and company have to say, but this is a chart that feels like it's coiling and ready to explode. Is this the moment where we see Tesla finally take the baton and help the NASDAQ stretch its legs to new highs?
Maybe. The problem is Tesla's not performing based on its quarter. It's performing based on, the sort of the ever changing perceptions of the future value of the company through the lens of this Muskian empire. And that's an almost impossible thing to price. I mean, for sure it is set up to make a run, but whether it happens right now, I don't know. I do think that it's good. I think the more time that passes between the period of time when Musk is super high profile in the political sense, in the Oval Office, just all over everybody's television, and the less public he is, and the more he does not exist as a public figure, and the more he just exists as a semi-normal CEO, the better off I think the stock will be. I think that just booking a couple of quarters, putting I think I mentioned this yesterday, but just putting the half-life of the politicization of the company in the past, and allowing the company to become more and more what it is as a company, as opposed to having it be a proxy for Musk's political activities. And so I think just getting the quarter well behind, now getting 2 quarters well behind, I think is very valuable in this context. And so I think that that's actually the most important thing, is just adding time.
Time solves all wounds, as they say.
Mm-hmm.
And getting more time between his stint in the administration and today could be helpful. Certainly from when he left in May, at the start of May, we know that he's going out the door. The share prices are up for what it's worth. So Elon Musk leaving government hasn't been bad for the share prices. But Dylan, it still feels like a late April environment where going into earnings, the stock price wasn't following the rest of the Mag 7 complex. And as bad as the earnings were, they weren't as bad as a lot of people still feared. So 336.64 here. The share price is closed at 332.56, so slightly higher after hours. Josh, I mean, we can complain about the market feeling overvalued. CTA positioning now is in the 90th percentile. As Dr. Data pointed out today, similar peaks in allocation. Let me just pull this up here. Similar peaks in allocation. Late 2014, early 2018, late 2020, mid 2023 have often been followed by declines, although not always immediately. This can be interpreted as CTA as being potentially vulnerable to reversals after building up large long positions. So I have my misgivings about the market feeling a little crowded right now near the highs, and I think the data supports that as well. But could this just be a case of rebalancing, right? Tesla just goes up and then this market has another 5% in it. We can't ignore that possibility.
Yeah, I mean, yeah, absolutely. The thing that scares me is when you start to see these meme reactions. That to me is the desperation of people saying, you know, this rally was talked about anywhere you looked as the most hated rally ever. And then it was the rally that nobody wanted to buy. And they were just, you know, and eventually that frustration built up. And I think what you saw was it culminated in the meme stock frenzy. I didn't see where any of those meme stocks closed today because, quite frankly, it was just too aggravating to watch. But that's the type of stuff, that type of behavior is what really makes me get a little bit concerned that, hey, you know, when we start throwing, you know, before the market had even opened this morning, I think was it Open had already traded like 7 million shares. One of them had traded just an astronomical amount of volume. It's like, okay, it's not a casino. And when we start treating it like a casino, bad things happen. So yeah, can we run up another 5%? Absolutely, 100%. But are we getting a little bit careless? Yeah, I can make a pretty good argument for that.
But I mean, by that, can't you make an argument we've been careless for a decade by that measure? I mean, I just feel like the market is indifferent to negative information, for a week or two.
Sure, that's a fair assessment. But I also think at some point, people do want to take some profits. So I don't think we're in danger of a 20% correction. I'm not arguing for that, but can we see a 5 or 10% correction? It was around this time last year that we saw something like that when you saw the the yen carry trade come off. So I think this market's been kind of reckless going back to 08, 09, when we saw the quantitative easing. So I would agree with you on that. I just think that, at some point people start to say, wait a minute, this is getting excessively reckless. Maybe we take some profits, just enough to scare the children. Then we jump back in and we get reckless, but not so reckless that we can't justify it.
There's we talk about getting reckless in this market. I'm not surprised. Dylan, we called this out on Monday that we were going to see some of this action. We flagged the share prices of RKT, Rocket companies, as a potential place to look, given its very extreme short float, sitting right around 50%. It topped in the market overnight. If you look pre-market on the 4-hour time frame, this hit a high of 1970 overnight before coming back in. There's a difference between like meme stocks rallying, like the Palantirs of the world and the Oklos and the SMR, names that are attached to thematic ideas that you find in FinTwit, like nuclear is going to be the next big thing. And then there's when like the crap starts to rally and pigs fly. And this feels like a pigs fly environment. But is that all that different than what we've seen in recent years?
No, that's kind of my point. That's why I feel like oddly bullish compared to you, because all of a sudden you're saying you don't like the quality of the names in the rally, as if the quality of the names and some of the activity of the last few years was anything particularly impressive. And I just don't understand I still am a little bit perplexed as to why you're more cautious now than you were in previous moments of effervescence. I'm not saying the market's not effervescent. It's obviously effervescent. I'm just saying I've never seen you view the effervescence with such a cautionary perspective.
I think 3 years in a row I've lost money being long the market through the summer.
Got it. So it's just the seasonal. It's the seasonality. You're like, I'm not doing this again.
I mean, July 22, the market went up a little bit, but I was leaning long then, and it came right back down by the end of August and still headed lower into September, October that year. We got the pullback in July 23, which culminated in the lows in October and November. But then again, great time to buy. Last year, we were dunking on Mike Wilson, the Morgan Stanley strategist, who has a knack for flipping sides at extremes. And sure enough, when he flipped long last July, that was pretty darn close to the top. So, unfortunately, I did see his research note for his second half outlook, Dylan. I just saw today that he's calling for a pullback in August and September now. So it feels like
research.
Well, no,
you're saying your operating principle is to actually be contrary to him.
For the last few years,
that you would prefer to be contrary to him anyway. You would not. Your first choice is not to be on the in alignment with Mr. Wilson. Is that what you're telling me?
He's a pretty interesting timing tool, is what I'll say there. But listen, if this market's going to keep squeezing, there's two things to keep an eye on, and that may mean adding a sprinkle of more upside to counterbalance some of the late August puts that are being held, and maybe even those need to be rolled up from my point of view. But I see a NASDAQ here with a top set of the range of 23,100, give or take a few points, then up to about 23,400, give or take a few points. A breakout would call for a 300-point measured move on top of that, and looking for further squeeze into the end of the month. We look to the July 31st expiration. We would add 300 points to that, 23,700, short the 23,800. It could be in the neighborhood of a 4-to-1 risk to reward trade. Not dissimilar from what was just done the last time the NASDAQ longs were taken, when it was looking long the 23,350, short 23,500 call spread that was closed out earlier this week. This may have been the dip opportunity to buy, Dylan, right? We pulled back to former resistance, turned support, and now we're rallying. But the measurement still calls for an additional 300. And so I look at that and I look at the Russell here, which this guy's been trading sideways for the better part of the past few weeks, and it may finally be breaking out itself today. I think even Ilya would agree that we've broken horizontal resistance here, having closed above the previous cycle high. Not just the closing high, but the absolute high. So a Russell breaking out and an S&P hitting an all-time high and a NASDAQ sitting right there and surviving Google and Tesla and those very important IBM earnings. Why not squeeze up a little bit more? Why not keep the party going for another week or two? So why not keep the party going for another week or two? Send it.
There you go. That's
filled.
my boy.
Let's get back on.
Boy. There we go. I don't
Dylan,
know
you're
what was
right,
going
though.
on.
I don't know what's going on either with me. Maybe it's like it's my birthday, so I'm feeling a little more conservative.
Today's your birthday?
No, last week, but it was like I'm feeling a little more conservative here.
You're losing your. You need the eye of the tiger, man. We need to get you back in the ring. We need to get. You need to start doing some pull-ups, some push-ups. So you to get your confidence has been shaken.
He needs sprints still.
Sprints and push-ups.
There was something romantic about the idea of the seasonal peak of the market this year falling on my birthday, and it's like I just can run this up long until my birthday. Blow up some balloons, and then the market will go pop on the other side of it. Like that. That seems like I'm the main character kind of syndrome. So probably
just sort of self-referential.
Yeah, very main character syndrome.
That's what you consider romantic. You tell your wife that? Isn't this romantic?
I whisper sweet nothings. S&P is going to 64. We're back.
Tesla's pulled back a little.
My boy is back in the game. Enough of this nonsense.
I feel a little bit better
go.
about my little short position here.
Dylan, isn't the ethos that the Trump tax bill is funneling all this money from the bottom to the top? The bottom 80% are getting tax hikes. The top 20% are getting a tax cut. The top 20%, they don't throw money back into more blue jeans and knickknacks or trinkets. They
invest in the
market, goes into assets.
Yes.
That's the macro trend.
And the tariffs are not going to be that bad.
They're going to be bad. They're still going to be bad. It's just it's going to get passed. It's going to get passed on to consumers. We were talking about this with Westwater earlier today on Futures Power Hour. Target just announced that it's no longer going to do price matching with Walmart or Amazon. And Dylan, was it last week we discussed this on the show? How if companies are going to pass on price pressures, it's really a three-stage effect. First, they negotiate with their suppliers, try to get them to eat the costs. If they then have to think about ways to pass it on and to maintain their margins, they start cutting promotions. They start cutting sales and discounts. And then they go into their revenue management tactics of raising prices, hoping that the volume down is offset by the prices up, and they can come out on the other side with their margins intact. And so Target's announcing they're ending their price matching with Walmart and Amazon. That's a phase 2 signpost, which means phase 3 probably comes in a few months. And at 14% of US GDP, just thinking about the math here, imports are about 14% of GDP, assuming no impact to exports, increasing the effective tariff rate from 2 and a odd change percent, 2.3%, up to 15, maybe 12 with substitution effects. Still talking about a percent decline on the high end of GDP over the next 3 years. Still talking about prices up a little bit more. But as we've seen over the past few years, tariffs haven't hurt this market. We've had tariffs in play and the consumer just adjusts and just keeps spending. Maybe this time's different. Maybe it's not. So wrong to get bared up the past few days. That's all I can say.
There we go. Now we're talking. You still have your insurance policy from the other day, so you're not just brazenly and nakedly long here. You still have your little backup plan. But the underlying issue is massive flow of resources due to the Trump tax bill into the economy. It will all go into assets, and there's no sign of real economic weakness despite inflation, despite the tariffs, despite anything. Any indication of relative economic activity is favorable. And, so I just don't see how you don't sort of hang on to all those things and just enjoy them.
Josh, are you going to stop worrying and learn to love the bomb like I have frequently done?
Well, I don't understand any of those things that you just explained with the 3 stages of grief or whatever that was you're talking about. I mean, I tried to follow. But I do know that when GM announced their earnings, they talked about eating over $1 billion in tariff costs, and next quarter being between 4 and 5 billion, and that seems like a pretty big number to me. And I understand what you guys were just talking about and the flows of the tax bill benefiting the wealthy, and they're going to put that money back into assets, and how that sounds so great. And it's when everything sounds so great that I get that's when you start looking around, like whenever my health is really good, that's when I get nervous, right? That's when you know something is about to happen. And again, I'm not saying that I think this market's due for some sort of like massive correction. It's just, it seems like it's frothy. My trading view is pretty much like 15-minute increments. Like I want to like put on a position, go get something to eat, go to the bathroom, come back and be out. Like that's my window of trading. I'm not a patient person, ask my children, but it's just, the way the tax bill is set, the way that the entire tax bill is set up is absolutely going to benefit wealthier people. They are going to invest that in assets. Logically, that should be good for the stock market. They are going to be buying more assets. Whether or not it plays out that way, we'll see what happens. But when you try and make a logical argument with a stock market that can be, incredibly irrational, I think you're asking for trouble. So again, I'm not looking at like we're going to crash, but I just think that we've had an amazing run. Let's just be rational for a minute. We've had an amazing run since the April lows. At some point, people are going to say, yeah, it's a lot of money I've made. Maybe, I do still want to get my daughter the $12 for Christmas or 70 pencils or whatever the hell it was he said. So I'm going to take some profits and buy that.
The macro level sector rotation here continues to hold up. That's been one of the guiding posts that I've had, Dylan, as you've known here. You're on this boat with me every day. When you have technology, industrials, finance, cyclicals, these are the bull market types of thing that's happened. Today, energy, healthcare outperforming. Maybe that's a sign of the economy being a little bit better than we anticipated. But generally speaking, right, financials here, at this level, this is going to be the second highest weekly close ever for financials. For industrials, this would be the highest weekly. In fact, today is the highest close ever for the industrials ETF. Telecom, highest close ever. Consumer discretionary has finally turned the corner, right? It was really struggling to get back through that January swing low. And when it does, this is just beautiful price action. Put it in a textbook. Resistance becomes support. And then we lift off. Even semis, Dylan. Semis have been the backbone of this entire rally. And today, after falling into their 1-month moving average, as we highlighted on the show yesterday, that's why those boxes are there, we bounce from the 1-month moving average. Again, it's an inside day after 3 days of decline. You'd call that the end of the decline for the time being. We have a level to trade around near 281. We're running it hot. Where is the best opportunity, though, in this stock market, Dylan? Is it getting crypto exposure? Is it semiconductors? Is it buying the stuff that's been lagging now and playing catch up? Is it YOLOing into Rocket and Open?
Well, let's just go down the asset list. I mean, let's assume that you're going to have sort of incremental new dollars looking for a place to go from the wealthiest people in the world. The obvious place for that money to go is into bank stocks, tech stocks, and crypto. I would say would be the three sort of Bitcoin, the Mag 7, and the big banks. who benefit the most, I think, just from the sort of flow of money to the rich from from the Trump tax bill.
It's hard to disagree with that, Josh, as we think about not just short-term trading, but long-term portfolio construction.
Yeah, I would agree with that. I think you left out shoe companies. But yeah, I would agree with that for the most part. What I don't get is your optimism on like, haven't you like taken like an 18% hit or something just living overseas in the
No, but I try not to bring. Listen, this whole situation has been a personal financial catastrophe, the likes of which I've never endured. But I try not to bring my personal issues into the overall discussion, because I believe most people live in a single currency world and they're oblivious to the total annihilation of the U.S. dollar. I don't have that luxury because fortunately, I have half my income in euros and half in dollars, but the dollar half of my income has been reduced by 20% this year. I've taken a 20% pay cut this year. But I just think that is such a tiny percentage of the world that even has that awareness. And so I think that, and in fact, because the dollar is declining so horrendously, I actually think that's why the stock market continues to perform so well, because the penalty for the Trump administration is not being incurred in the U.S. stock market. The penalty for the Trump administration is being incurred in the U.S. currency. And so it actually allows the U.S. stock market to perform much better than it otherwise would, because of the abomination that is this U.S. dollar chart that my dear friend Chris Vecchio has no choice but to remind me of as I look at the catastrophe that is my personal income.
But aren't you worried that could be contagious?
Contagious for what? I mean,
the currency decimation that could spread to the euro.
I mean, by definition, the euro has to be stronger as the dollar gets weaker. In fact, there's no greater.
But couldn't there be some degradation to the euro, some improvement to the dollar, but overall net, both currencies end up taking a hit as a result
in favor of what? The yen and the Canadian dollar?
Maybe it's crypto. I don't know.
But what alarms me here, this is again one of those signs. Ilya loves pointing this out all the time. But volatility in the currency market had crept up in March around these tariff headlines, and it started to rally again in early April, started creeping up again in early April once the tariffs went into effect. And the IVRs in the currency market they're up there once more. 46.2 in the euro. You go over to the pound, 50 even. Canadian dollar. Fix you. Canadian dollar, 58.2. Japanese yen, which is a real PITA for me, although it's only up by 0.04% today, only a 14.3. When the world's largest currencies have volatility that's trending higher, and this is the deepest, most liquid portion of the market globally, it always raises an eyebrow. Makes me think that things are a little bit less stable and sturdy than they appear to be. But I'm trying to make heads or tails of today's action. We talk about the buy America, sell America dynamic here frequently, Dylan. Buy America would be stocks up, bonds up, dollar up, gold down. And sell America would be the exact opposite, gold up, and then stocks, bonds, and the dollar down. Half that equation's in check today. Stocks are up, gold is down. Buy America. The other half is not. Bonds are down and the dollar's down. So how do we square the circle here? Is the stock market's jubilation over the news flow over the past 24 hours, is that the tell, or is the bond market?
But I think you have a different fundamental issue, which is the credibility of the U.S. government and U.S. currency is at an all-time low. And so I think you cannot underestimate the degree to which the risk and the penalty for the catastrophic American government is being jammed into the currency to the benefit of the U.S. stock market. That the traditional sort of strong dollar, strong stock, the sort of strong America, like it's a weak America, a weaker than ever America, right? Thus the catastrophic weakening of the currency that's then allowing for what amounts to an inflation offset. On a dollar adjusted basis, are stocks up at all? They're probably down on a dollar if you're a euro investor.
Yeah. Yes, that's still true.
So I just still think, I mean, I can obviously be wrong, but I just think that in this situation, it's not a traditional buy America, sell America, long America, short America situation. It is how do I say it? It's a America in decline, but the decline is based on a wealth transfer to the wealthiest Americans, which benefits the stock market and diminishes the currency. Like the reason for the decline is because what's left of the money is all being given to the richest Americans so they can jam it into the stock market. And so on the one hand, you're like, oh, this is not a well-run country and the currency's lost all credibility. And rates are coming up and inflation is a risk and all that jazz. And at the same time, the reason or one of the reasons that the economy is doing or that the currency is in such jeopardy is and that the countries that the integrity of the country is in such a compromised position is because there's a short-term phenomenon of raising taxes on the lower 80% and cutting taxes for the richest 20% so they can jam it into the stock market.
Josh, you have anything going on with rates here? It's not a really.
I'm trying to get my head wrapped around it because I'm in the same boat as you. I have a hard time, initially when I was thinking, rates are, we can't cut rates, they're going higher. Then we had this bit of a reversal this week. And was it signaling that, a recession? Was it some sort of a recession indicator? I can't get my head around what exactly is going on there. I think what Dylan just suggested makes a lot of sense as well. I don't have a position in bonds. I think right now bonds are in no man's land. When they get down around 112 handle in the long bond, I find them attractive and I'll buy them there. But right here in this 113 area, I don't have a position. They're of no interest to me right here.
I mean, I'm still trading them directionally neutral, so just a little bit of jostling. I'm hoping for theta decay. That's the name of the game. That's it. We just need this thing to continue to bounce back and forth, both in notes and bonds. So I suppose that's not disappointing. Silver today did pull back after stretching to new highs, although we look at that 4-hour time frame, and I'm going to squint and say that we're trying to hold up here. That's why I rolled out of my SIU 5 contract today with 34 days to expiration. I noticed the market was up 0.5% earlier, and I just wasn't making any more money on the position. Right? It should be I should be making hundreds of dollars on a 50-cent move in silver, or 0.5% move in silver, like 15 cents. I should not be making like $75. So I got out of the 38.39 call spread, 34 days to expiration. I went out and looked at what was happening in October, Dylan, and I couldn't help but notice at 64 days, the long 42, short 43 call spread was a max loss of $1,255 at 30% probability of profit. But by just going out to 97 days, that same 42, 43 call spread, it was only $1,370 risk with a 33% probability of profit. And I said to myself, is risking another $120 or so worth another 33 days in a trade from 64 to 97 days? Is it worth $4 a day? And the answer is yes. It's worth $4 a day.
I would think it is yes.
Yeah, I think it's worth $4 a day to size up a trade where it's still potentially in the neighborhood of like 2.5, 3 to 1 risk to reward on a 33% probability of profit. Looking for the SIZ5 contract to go up there on our charts. We're talking about a move that would extend to the extension here. Swing low, high, low, sweet chariot, and that pulls you into 4150 as a start, as a near-term target. So you get to 4150, you get some vol expansion. These calls go up a little bit in value, take them off. You get a pullback, put them back on. It's kind of how I intend on playing it. But having long-term exposure to silver, Dylan, as you know, for the past 2 years has been wonderful. So I'm not going to say we're going to corner the market, but this seems like an opportunity to extend duration to buy ourselves a little bit more time, not expose ourselves to a potential pullback like we saw the last week. As we get closer to expiration, which takes a lot of our gains off the board. Position management is prudent at the end of the day. So yeah, I'm looking for more gains here, but made a slight switch. Market seemed like an easy decision where to lay out the next trade. Can I entice you into getting into silver with me?
Yes, you can. Yes, wow, you can. I mean, just especially with the dollar gone straight to in the ditch. You know, what am I left with at this point? I'm never going to buy gold. It makes me, I don't even like gold. And also all I'm left with is silver. So hell, I'll buy some silver.
You're not a buy gold, wear diamonds kind of person as an investing strategy?
No, but maybe I should be.
Maybe. Josh, what are you doing in the metals here? Today wasn't a great day for gold traders.
I find the metals to be so frustrating to trade. Mm-hmm. You know, I've been trading. I started investing when I was 14, I think. Yeah, 14. So I figured out what my tolerance is, what my patience is, and I find metals to be like green vegetables. Like, just not my thing. Just, they don't do anything for me. Silver in particular, I just seem to have the worst timing with, so I don't have a position right now in silver. I actually am looking at it right now. I keep it on my screen and I watch it, and I use it as part of just an overall market awareness piece. But I don't really do too much in it. Same with gold. On a rare occasion, if I think it's in an extreme, I might take a position. But no, I haven't. I couldn't even tell you the last time I had a position in silver actually was the end of last year, and it didn't work. And I swore I'd never trade it again.
I'm on one of those stretches with natural gas right now. I was in some short put spreads. They were working, then they didn't work, and so I got out, and then the market rallied back, and I felt like an idiot, so I decided to go directionally neutral. Now it's down like 10% this week. When I go into the stretches, yeah. I find it's a good time to step back from the product. Just personally. There are some things where if like I try to, I put on some like test trades sometimes. I'll paper trade some things just to watch the market. And if I can't like if I can't back test this, including fees and what have you, and not just assuming like there's a zero bid ask spread, which is one of the shortfalls that a lot of back testers do. They don't think about the cost of actually executing their trade. If I can see that it's working out, I may then start to put some capital into an idea. But there are other times where it's like if I get out of the market and with natural gas, if this is a loser for a second time in a row, I'm going hands off for 2 to 4 weeks. I'm not going to touch it again. I just need to let it drip away from my mind, from my mental map. I need to forget my biases that I see when I look at the chart. I want to forget about the fundamental data with inventories and tariffs and just kind of allow my mind to reset for the product. I think that's typically helpful. And I think people should.
I can hold a grudge with the best of them.
But the point I'm getting at is I don't think people should hold a grudge. Just give yourself a reason to back off. I know some people who like just absolutely eschew certain products. Fine. Natural gas is hard to turn away from myself because of the volatility here. It's one of the few things with an IVR north of 60 right now in the futures market. And that's our lantern. So we're drawn to it. I digress, though. Gold here, big pullback today. Dylan, I know that you're not a big gold guy, but in further, respect to our missing Soviet friend here, he would probably argue that this diagonal trend line doesn't matter at all. It's not a false breakout to him because we never really did break out. We never cleared the June 15th high. But the horizontal support here that you see through July 11th, that you see on July 16th, right near 3290, that didn't break down today. So consistent with that view, as someone who is leaning long gold right now in the GCV4 contract, if we see GCQ5 break down below 3390, that sets us up with what I would then consider to be the classic false breakout, return to the other side of the consolidation. 3225, look to get long again there or ride it short down. But either way, I again, at a crossroads where for at least gold, if we're going into this frothy environment, it's a catch-up time. And silver and other metals probably catch up more than gold, which has been an absolute monster this year. you're not a gold person, but does this chart stick out to you? Is it interesting to you that gold didn't break down in a more significant manner today?
Yeah, I mean it is. I mean, and I think that if there was a time to buy gold, this looks like a darn good one. I mean that this is of everything that gold has done. This to me is actually the most interesting thing that I've seen since we've talked about it, just because it's performed so well for so long, and it does have that sort of big downdraft in it right there, which seems like more of an opportunity than a liability.
More of an opportunity than a liability. It's interesting that you say that this is a good spot because we are technically near support. So let's say we wanted to swing something against here. Doing it in the gold futures this time of day and even when the market reopens could be a little difficult. But considering this is a scalp swing trade, you could go in to MGC where your tick value is $1, full point multiplier is 10. Okay. At 33.99, we'll call it 3,400. We're risking $10 on a potential trade in the MGC contract, risking $100 in GC. I think that's reasonable if you want to just swing this directly through the futures. If you're going to sit on top of it overnight, hold 33.90. That's your support level. You got something to work with tomorrow to scalp around. Below 33.90, you take your dollar tick loss. Tick size is 10 cents. So you're risking $100, you're risking $1,000, like whatever. The point is that there's a way to approach this here that doesn't need to be through options right now. It's feasible if we got to think about trades for the second half of the week. 33.90 is a level to, 33.90, 33.75. It was resistance. We can trade around there. Josh, what's the most important theme that you're looking at in the market? I think having someone like you on the show is really interesting because you're not necessarily on air or in front of the camera. You're one of the people who pulls the levers and makes the rest of us look good. So you have a different, the point is you have a different relationship with the market, right? Than either Dylan or I do. What's your perception here? How have you digested all of everything that we've talked about that you hear Tom and Tony talking about on camera?
I do have a different take, I think, from most of you guys because I do spend an awful lot of time scalping. Part of that is my personality. Part of that is because my daily activities at work require a lot of time. And so, I try and just get a position on and off quickly when I have a minute. So I'm looking at things in a very finite time period. Like I said earlier, I do like to take a look at things in a bigger, I'm engaged in a macro and a geopolitical level. So I have opinions about things overall and where we're headed. I certainly have convictions about what's going on in the market and where we're headed. I've said a few times, I think that equities are frothy. I think bonds and interest rates are trying to figure out just exactly where they want to head, what's going on with the Fed. I think that I don't think Powell's going anywhere. But I did hear an interesting perspective earlier today from somebody that they thought he should resign. Because what does he have to lose by resigning? I mean, at this point, it's okay, fine. I'll leave, have it your way, and it's on you. If I leave and you bring in somebody and he cuts rates and the markets respond positively, congratulations. But if I leave and you bring in somebody and they cut rates and the market takes a shit, well, that's on you as well. And it's kind of you're calling a bluff type of move. I don't think that's necessarily going to happen, but it was an interesting perspective. I think that inflation is even with these trade deals, which, to be very blunt, we haven't seen the details. We've heard
the White House actually just released a statement saying that any discussions around a possible EU trade deal should be considered speculation.
They're all, I'm sorry, they're all bullshit. Okay, he mentioned the deal about Japan last night, and it's going to include agriculture and other things. Well, that's very hard for me to work with. I want to see
like the Boeing. They're going to buy 100 Boeing planes. Is that over the next 5 years?
Exactly.
Is that over the next 40 years?
There's not been any details on any of these things, and great that we got to deal with, some of these smaller countries, but the countries that we actually trade with, let's get some details, because until we do, as far as I'm concerned, August 1st is problematic for this country. It's going to be a shit show. So, I think that I think equities are frothy to begin with. I think that inflation is a week away, give or take a couple days. And it concerns me. We're about to embark on a course that we haven't gone down, with maybe the exception of Smoot-Hawley. I mean, you got to go back that far really to see like excessive tariffs, and that didn't lead to a good place. So I'm a bit pessimistic, obviously politically, if you haven't picked up on that, but also on how that's going to affect us economically. I think that I don't see what was so wrong. I mean, there's certainly economic disparity and those issues, but the policies that we're enacting right now, they're not going to work. Trickle-down economics just doesn't work. There's just so much evidence that it doesn't work, and we're just going knee deep, a little higher than knee, a little lower than
neck
waist.
Deep. I think we're neck deep, Josh.
Neck deep. Thank you. Neck deep. It's like, why are we? It's not going to make. It's going to make things better for the
It's going to make the stock market go higher. It's going to make the stock market go higher, bro.
It's going to make the stock market go higher, but who's that going to actually help? I mean,
nobody.
When I started investing, the first stock I ever bought, I'll never forget it, was Pillsbury. And the stock was trading about $28. And that wasn't an unusual price back then. Today, you can't find a stock under $100 to trade. Who can afford that? So,
listen,
it's the stock.
We have the America has been split into two, the haves and the have-nots. The president works for the rich. Everyone else can go to hell. But if you're going to be involved with the stock market, I mean, listen, as you know, I took a massive moral position 13 or 14 years ago, and a lot of good that did me. So I just think that at this point, if you're going to be, you can not play, but if you're going to play, you're better off to play and just play along with the scam that it is than to live in some sort of moral conflict with it, which is only going to prevent you from making money.
Yeah, but you can look yourself in the mirror, and I have respect for that. So, listen,
you guys can see your reflection in the mirror? Something's wrong with mine.
Listen, I can be completely wrong, and I can accept that. And I want the country to do well. I want these policies to work. I've done my homework. I've spent the time doing it, and I have a very, what I would consider to be a pretty educated opinion on it. So, but again, my time frame for trading not that long. So, I mean, I've done like 4 or 5 trades while we've been on there already. They haven't worked out particularly well, by the way. I was kind of expecting Tesla and Google to shit the bed, and they didn't to the extent I was hoping.
Joshua, I'm looking at this S&P 500 contract here, and I'm listening to what you say about doing the work, and you sound like a real nerd. No offense. So we're going to.
By the way, I was like 2 points away from getting out of my cruise trade, and then I just turned and went the other way, and I had to have my 2 more points, and that's the bane of my existence right there.
I'm like that all the time. I'm with you. If we were to take an extension here, the swing that we have on June 22nd, highs mid-July, and then back down to the low on the 16th, that gives you a 100% extension at 6675.75, which would be a heck of a run here if that were to actually transpire. But thinking about that playing out, if we want to go run it real hot, this is the run it real hot trade, 6675. I mean, that's not even outrageous to get there by the end of this year, guys. We're talking about plus or minus 500 points into the end of the year priced in ESZ5 is trading at 54.62. Getting to 7K is not out of the realm of possibility. That's the 1998 playbook, Dylan. Right? We chop around here for the next few months. We don't have a really big pullback. And then this thing takes another gigantic leg up. And like we're closing the year 67 to 3,000. Gosh, it could happen. I can't believe I spent 48 hours doubting the sanctity of this market.
Thank God you've come back to your senses. I was deeply confused.
Is that an adopted baby if it did it? Is that the sign that it would make on the chart? Is that an adopted baby?
These technical terms. I call you a nerd. What am I?
Show me a ninja star. What does that one look like?
3 counting
crows. You guys have all your technical analysis.
We close out the session with stocks at highs. This is going to be a new closing high for the NASDAQ here when the futures market officially closes at the top of the hour. 23,411, S&P 6406. Mission accomplished, gentlemen. We'll be back tomorrow because overtime is out of time. Thanks for tuning in. Overtime is on every Monday through Thursday here on Tasty Live, 4 p.m. Eastern, 3 Central. So be sure to come back for it this Thursday to finish out the week. For Josh Fabian in somewhere close to Wisconsin, Dylan Radigan, parts unknown. I've been Chris Vecchio in New York. Good luck trading. See you soon.
So I studied economics and international relations, and I wanted to do the hands-on rather than the academic version of that, and the most natural thing was global macro investing. I begin with a sense of where I think the overall direction is for the macro theme for the next 6 to 12 months, and then look at some basic response from the price action to see how it's going. I think the price itself is the purest of indicator. It subsumes within it the collective emotions of the market. One of my favorite mottos, if you will, comes from the always great Ira Harris, who said, if you're right at the wrong time, you're wrong. And so for me, every macro narrative begins with what's the price action saying, rather than this or that economic indicator or some such thing.
It is a quiet day for stock markets as the big, beautiful bill championed by the Trump administration clears its hurdle in the Senate and now heads to the House. We get a little bit of a update from Fed Chair Jerome Powell, and we get some troubling manufacturing data. I'm going to try to make sense of all of it here on Macro Money. This is Ilya Spivak, head of global macro at Tasty Live. While we have this opportunity before the next big batch of event risk hits the tape, we're going to try and take this step by step and get into how at least one macro-minded trader, this one, would unpack this news flow on a given day. And the main question that we have here, as I can see it, is whether the makeup of what we saw today suggests that the Fed is right to be as worried as it sounds. Because the markets seem to think that the answer is both yes and no, depending on which worry is in question. And how things are positioning then, and what the markets do across major assets, should be majorly influenced by whether the Fed, at least in the market's estimation, is worried about the right thing. So let's take a look at the price action here. First, we have the S&P here down about that's not correct. It should be 0.09 because it was nearly flat here on the day, whereas the decline in the Nasdaq really is as big here as it seems, and it's not the biggest decline in the world. There we go, fixed. That's accurate now. And the S&P, for its part, flat on the day after testing near its year-to-date highs. And that's really on the back, seemingly, of this big, beautiful bill situation. Because what we have once we get into the internals sector-wise is outperformance for small caps. The Russell tellingly higher today by a good margin, adding a meaningful 1% today, and the Nasdaq down by almost an equivalent amount, as we say, 0.89% here. And that breakdown seems to sort of broadly reflect the priorities in this bill, and perhaps the expectation that it is likely to get passed. Healthcare up, financials up, consumer staples up, but technology and communication services, sort of looking at the sector breakdown, both down. So this seems to speak to that impact here. Yields, interestingly, a little bit higher at the front end, but still relatively anchored at the back end. Perhaps this reflects the near-term inflationary implications, at least to some extent, of what we saw in this bill. It is expected to increase the deficit by something on the order of $3 trillion. And of course, that's spread out over 10 years. But one sort of more immediate impact here is an update in the state and local tax deductions. This was a big sticking point after the 2017 tax cut program in the first Trump administration that significantly reduced the amount of state and local taxes that could be written off from federal taxes. And this significantly increases the cap from 10, it looks like, to about $40,000. And so a meaningful increase, and that perhaps puts a little bit more money in the hands of consumers, which may be inflationary in that it sort of gives a cash infusion into consumption sometime next year. So maybe we have a lift in the 2-year that sort of follows along those lines, but the 10-year here is still relatively anchored. Crude oil, despite the marginal increase today, still very much in consolidation mode since those geopolitical tensions washed out of the price. Gold a little bit higher, the dollar a little bit lower against its major counterparts. The pop in gold, in particular, interesting here with yields doing what they're doing. Typically, you wouldn't expect gold to do well in an environment where yields are tracking higher, but the sort of story here seems broadly to follow what's been going on in the yields space today, and that's in the wake of comments from Fed Chair Jerome Powell. He spoke at the annual ECB forum in Sintra, Portugal, and it's an interesting story there because what we seem to have today is a very different kind of a story for Fed policy odds than you necessarily have for the broader yield structure. And of course, there's an impact, but that impact seems to be largely downwind for maturities. The message from Powell was not an unfamiliar one. This is basically a rehash of what was said at the testimony last week when Powell testified in Congress, as well as 2 weeks back when he spoke at the press conference after the FOMC policy announcement. The economy is in a good position. If not for inflation risks from tariffs, we might be cutting rates already, but we are expecting, that is, the Fed is expecting to see higher readings for inflation over the summer because of those tariffs. And what the Fed wants to make sure is that we don't then have those inflation readings enter into inflation expectations and then become anchored, which of course would undermine all the progress that the Fed has already made in bringing inflation down. It is, after all, looking at the latest CPI data, just 2.4% at the headline, so less than 0.5% above its target. And the argument here is a familiar one, that with inflation that low and with the unemployment rate at 4.2%, which is historically low, or low by historical standards, not the lowest in history, certainly. We got as low as 3.4% when we were coming out of COVID, and there was a mass return to employment. Labor force participation obviously has evolved significantly, but nevertheless, historically, 4.2% is very low for U.S. unemployment. And so, not surprisingly, what Powell is still saying here is there isn't a growth emergency, there isn't an inflation emergency. We have this weird thing with the tariffs that is something of a black box in terms of its impact. It doesn't make sense to jump out the window and make a decision when there isn't a flashing red sign somewhere in the economy compelling you to do it. So what they're going to do is sit on the sidelines, and that's despite the general consensus on the Fed clearly being that rate cuts are appropriate this year, and perhaps most interestingly, Powell saying that he can't say whether July is too soon to consider a cut, which basically means that every meeting is live at this point, though the markets are only pricing in about a 20% chance that the cut actually happens in July, and we'll take a look at that momentarily. On the data front, we have a slightly better than expected reading on the manufacturing side of June's ISM economic activity surveys. This is basically another version of PMI. The headline PMI numbers, of course, coming from S&P Global. That's sort of the biggest provider of PMI data for most of the world's countries. Some countries have more than one set of these numbers from different providers. China has that, and so does the U.S. The Institute of Supply Management is a very long-running survey on this and very closely watched. And what we see here is that the manufacturing sector remains in contraction mode here, as ever this is done in the logic of PMI. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what you have here is a fourth consecutive month here below 50, and that suggests that whatever pop you had in manufacturing in January and February, that's this right here, where you crossed back over 50 into positive territory, ostensibly around the front running of tariffs, that is increasingly spent. And we're back into a contracting mode here, but it is the internals of this data that really grab attention and give the Fed chair some coverage in what he is saying, because what we have here, there's the 4 months of contraction here, readings sub 50 in the yellow bars, but when you look at the internals, the price component is surging. This is in fact the fastest price growth that we've seen in 3 years, going back to the middle of 2022. And it's happening at a time when that price growth isn't being motivated by economic activity in the sector, clearly, because not only is overall activity actually shrinking, but we can see here employment down. Fastest contraction in employment in 3 months. New orders down. Fastest contraction in new orders in some time. So what we're looking at here is an inflationary shock, not demand pull inflation. That is to say, more people want output, and so they compete on price, and the price goes up. That is not what this is. This looks like the kind of stagflationary risk, or at least stagflationary dynamics, certainly not stagflation economy wide, but the kind of stagflation dynamics that the Fed is worried about. And indeed, we saw 2 weeks ago from their summary of economic projections, they're downgrading expectations for growth, they're increasing expectations for the unemployment rate, they're increasing expectations for inflation. And so that's exactly what this ISM data seems to imply. But of course, the big disparity continues to be what to do on rates. The Fed seems to think that we're going to have this kind of shock here where growth veers in a worse direction, inflation veers in a higher direction, but ultimately things settle relatively in the longer run. And what this inflationary shock ends up meaning is that the Fed can cut less because they don't want to let inflation out of the bag as this washes through the economy and becomes what the Fed hopes will be a one-off, a transitory influence, as it were. And so what we have is a downgrade in rate cut expectations for 2026 and 2027, where before we were going to get 50 basis points this year and next. Now we're looking, and then a 25 basis point cut in 2027. Now the timeline is extended. We only get one cut next year and one cut in 2027. That, of course, is not at all endorsed by the markets. So here's 50 basis points right here. The markets, for the most part, are where the Fed is there. They have 58 basis points for this year. So they're only a bit over where the Fed is. And indeed, if you look at the disparity here, there is about a 32% chance, 8 basis points out of 25, that you're going to get a third cut. But 32% is not nothing. But it does suggest that the Fed is broadly in line with markets, at least for this year. For next year, though, it's a completely different story. The market has 68 basis points on the menu. That is to say, it's fully baked in 50 basis points in cuts. So that would give you the full 2 cuts there. And in setting it at 68 basis points, it suggests that we are a very good way to getting now to 3 cuts next year. So 68 basis points is 18 on the way to a third 25 basis point cut. So the probability of that third cut next year relatively elevated now at 72%. Now, if the Fed is saying 1 cut next year and the market is saying 2 and a 72% chance of a third, that's an entirely different kind of perception on what is likely to happen. Indeed, if we take a look at even this year's trajectory, we can see that since the Fed basically made the case for all of this with June's policy announcement and issued that summary of economic projections that we just saw. Since then, the path even for this year has become more dovish, even as the Fed has said all of the same things. We can see the curve here has actually edged down. Now, that gives us the first rate cut in September, second cut somewhere here in October, December, with a fairly decent shot, even at a third by December. But as we saw here, the trajectory is still favorable of 2. So what is it that the markets are seeing here? Why are they so much more dovish than what the Fed is saying, even as the Fed keeps saying the same things over and over and over again? And we get back to this idea that from the market's perspective, the Fed is wrong to be worried about inflation risk. When we look at what this begins looking like at the beginning of the year, here's the S&P 500 in the yellow. It is falling alongside the bond market's measure of expected inflation. These break-even rates are the difference between nominal and real interest rates, so nominal yields and TIPS yields, that extracts the inflation adjustment that it would take you to get from nominal to real. Obviously, nominal rates minus expected inflation is what gives you TIPS yields. So if you take the difference between nominal and TIPS interest rates, the magnitude of that inflation adjustment is what you're left with. So you can see that these inflation expectations in the bond market were falling with stocks from about mid-February and until the beginning of April, around the idea that the tariff rollout as it was happening would be negative for economic growth. And of course, when you have that kind of influence, as positive economic growth would boost inflation through demand pull dynamics, here you'd have demand destruction, and so lower inflation, less upside pressure from demand on prices, which is exactly what you see here. Then, of course, we get the Liberation Day back and forth, and clearly sentiment recovers here. The S&P 500 is back to where it was pretty much at the start of the year, but inflation expectations have not followed. In fact, the nearer term 5-year here is basically where it was at April's lows. And so the market is saying here, the bond market, we have a growth scare that hasn't gone anywhere, still very much on the books. Just because stocks have rebounded doesn't mean that it's anything different here in terms of growth dynamics, which is why ostensibly they want all of this easing. Because while the Fed is worried about the tariff risk, the market obviously is not. And it's saying the Fed needs to cut to underpin growth. To that end, we can see here the Atlanta Fed's GDP growth now model. And never mind whether it's actually right about where second quarter GDP is headed. That's ultimately not important. We're far enough away from those numbers that this model is going to change quite significantly between now and then. More importantly, what this model is a distillation of incoming economic data as it appears. And by the way, the ISM numbers from earlier today are now in this model. So what we see here is the tone of the data going into the model since about mid-May has been clearly negative. And so the way the wind is blowing, as it were, for the U.S. economy is toward weakness. We see the same thing from the economic surprise index data that Citigroup puts out. We can see the U.S. is clearly the weaker hand here across the major economies. In the blue here, if you squint, is the global reading. It's been heading lower, and we can see that it's been heading lower because of what's going on in the G10 economies as emerging markets hold up here. And we also see that whatever's happening in these G10 economies isn't happening because of Europe, which we can see is holding pretty well here as well. So clearly, it is the U.S. that is now the main drag on the tone of global economic data. And this, of course, tells the same story. So what we find today, then, is a manufacturing survey that generally tells us the Fed is right to be worried about what is happening here with prices and with demand diverging in an adverse way. And so in that sense, what it's saying here makes sense. But also that the markets are looking through inflation and saying the impact on prices will ultimately register not as sequencing, where first you get the prices, then you get the hit to growth. No, the markets are going to be focused on the growth, which is already coming undone. And that beckons rate cuts because inflation is going to get pushed lower by the demand destruction of an economic downturn. And how this gets resolved and which way it gets resolved ought to be very impactful. The dollar, of course, has been falling with this deterioration in the Fed policy outlook, and stocks seem like this rise was built primarily on sentiment, but certainly not invulnerable to growth concerns when they become acute. And so with that in mind, there is perhaps a vulnerability for stocks to come in and for the dollar to rebound if this starts to shift this way or that. With that, we're going to be watching out for the next layer of this ISM data that's coming later in the week for the all-important service sector. And then, of course, the U.S. jobs report as well, which we're going to focus on in depth tomorrow when Macro Money returns, as it always does, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close. In just 30 minutes' time, I'll be on, as I am every Tuesday, with Victor Jones for The Price of Truth, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money will be back.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today. Got the need for speed? No problem! At Tasty Trade, you can turn smart ideas into real trades with just a few clicks. Wow, that's fast. Tasty Trade, make your move.
If you missed the live show, here's our cherry on top weekly recap.
But I'm doing 2 talks in Mexico City, and then I'm doing 2 talks in Guadalajara.
I mean, all it's going to take is for this administration to read just one of your past cherry bombs, and you're not coming back into this country.
I hope they don't subscribe to the cherry bomb. Oh, no.
You better scrub your phone, honey.
Oh, no.
You better wipe it clean.
This is the same kind of group. We've been friends for, I don't know, like 30, 40 years.
Yeah, that's a long time.
I know.
Because it takes work to maintain friendships, because life gets in the way.
Guys, with women it does.
Well,
it takes work.
Men don't ask questions. Men are the worst. You're like, oh man, my buddy's getting a divorce, and everyone's like, oh my God, why? What happened? You're like, I don't know, I didn't ask. And you're like, what is wrong?
If we have a friend and they're getting divorced, we already know why.
Oh, just pure chaos already this morning. They dress alike, they act alike, they talk alike.
Well, my producer said we all look like seamen, is what he said. Yes, the sailors of yesterday. It's lighter than it looks. I will give you that. I mean, it's...
So is Tom.
I just thought it was unusual that Tom would wear like a long sleeve hoodie in the middle of summer. Why don't you give away that hooded sweatshirt in the middle of summer? Why don't you give that away?
It's actually a summer outfit.
It's a summer outfit.
You would not know.
So I said, I have to see what this is like. And it is a boat-worthy apparel, so I'll ship it down to Florida. But I just wanted to be like my man Tom, see what it feels like to be a big shot and stuff like that.
Will you guys please wear them matching on the flight to Denver next Friday?
What's going on? What the hell am I looking at? What the hell's going on here? What is this?
I'm twinning.
Join us. You got to go white then. You got to get something. Yeah.
No, I don't want to mess this thing up. This is too perfect.
Be like Tom Day here at Tasty Live. That's right. You too could dress like an overlord or just look like one.
Get the full scoop by checking out the archives at tastylive.com. If you missed the live show, here's our cherry on top weekly recap.
But I'm doing 2 talks in Mexico City, and then I'm doing 2 talks in Guadalajara.
I mean, all it's going to take is for this administration to read just one of your past cherry bombs, and you're not coming back into this country.
I hope they don't subscribe to cherry bombs. Oh, no.
You better scrub your phone, honey.
Oh, no.
You better wipe it clean.
This is the same kind of group. We've been friends for, I don't know, like 30, 40 years.
Yeah, that's a long time.
I know.
Because it takes work to maintain friendships, because life gets in the way.
Guys, with women it does.
Well,
it takes work.
Men don't ask questions. Men are the worst. You're like, oh man, my buddy's getting a divorce, and everyone's like, oh my God, why? What happened? You're like, I don't know, I didn't ask. And you're like, what is wrong?
If we have a friend and they're getting divorced, we already know why.
Oh, just pure chaos already this morning. They dress alike, they act alike, they talk alike.
Well, my producer said we all look like seamen, is what he said. Yes, the sailors of yesterday. It's lighter than it looks. I will give you that. I mean, it's.
So is Tom.
I just thought it was unusual that Tom would wear like a long sleeve hoodie in the middle of summer. Why don't you give away that hooded sweatshirt in the middle of summer? Why don't you give that away?
It's actually a summer outfit.
Join us. You got to go white then. You got to get something. Yeah.
No, I don't want to mess this thing up. This is too perfect.
Be like Tom Day here at Tasty Live. That's right. You too could dress like an overlord or just look like one.
Get the full scoop by checking out the archives at tastylive.com.
Tasty Trade has crypto, and you can trade with 0 commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
All right, we're back. I'm Dan Cecilia, and with me today is Shelly.
What up?
My partner in crime, part of the Crypto Cave. And Shelly, what we got going on today?
So much, as always. Crypto's an exciting realm to exist within. How are you today? And hello, chat. See Flower Power 2222 in the house.
What's up, chat?
Emmett. Ooh, I have to open our X stream as well.
If you guys are with us today, we got a pretty casual show today. We'll be looking at some stuff. We'll just be going through some coins. If you guys have anything that you want us to cover, you have any questions, literally anything, drop it in the chat. We'll cover it.
Literally anything, he said.
Yes, but also not literally everything. So where do you want to start?
What's up with the headlines? What's going on in the world today?
Hey, yeah,
hello, Lone Sophos, Emmett, Catan, Dav.
Today we're a little bit down looking at the market. I got Bitcoin chart up here on the Tasty Trade platform. We're down 1%. We're about 117, 118. I see ETH ETFs see third biggest day of inflows while Bitcoin sees net outflows. That could be an indication of rotation to altcoins. Alt season might be upon us. Coinbase partners with PNC Bank for crypto as a service model. thought that was kind of interesting. Coinbase kind of bringing their capabilities to major banking provider. Goldman and Bank of New York Mellon to offer tokenized money market accounts. Okay. And then the meme coins Pangu and Rect. So Pangu is Pudgy Penguins, for anyone out there that's into NFTs. They hit all new all-time highs. So those are the major headlines that I kind of caught my eye. And yeah, I mean, I think the ETH ETF third biggest day inflows, while BTC ETFs see now outflows, is kind of that's pretty interesting. I need to find I need to see if I can find the ETF inflow and outflow website, but I don't know, anything you're looking at?
To be honest, I have been a little distracted, Dan. We've got a lot going on internally here with the stablecoin funding, all very exciting things happening. We are bringing so much to the table here at Tasty for our customers. So in chat, if there's anything missing in our products, let us know. We're listening. We're listening like real close. So yell from the rooftops. And but yeah, so we've got the wheel today. I did that with Ryan before. I don't think you and I have ever done it on this show, right?
I don't think so.
Okay, so the wheel of crypto, running it back. And so for anybody that hasn't experienced the wheel of crypto, it is all of our crypto offerings on a wheel. We spin it, and then we just talk rapid fire about whatever it is. And if you have any specific questions, throw them in the chat. But the wheel is just a fun way to cover a lot of content really quickly. But do we have a question for the chat?
Do we have I don't have a question.
I have a personal question. Who's been to Europe? Because I'll be gone for 3 weeks.
We'll be gone.
Yeah. 3 weeks. I'll be out next week, starting next week. So hitting Norway, Italy, Austria, Germany. And I wish crypto was more like just the everyday normal thing, because now I'm like, wait a minute, how does currency work over there? Do I have to bring fiat and transfer to all these different currencies and yada yada? I'm like such a noob when it comes to like traditional money rails, but
yeah. I have a couple big, let me see here. Oh, Big Deal Donuts. How'd Link do today? I'm looking at the Link chart right now on the platform. We're down about 10%, 9.7%. So a little bit of a sell-off there. Might be a good time to scale back in. I mean, it did kind of skyrocket here in the month of July. It's been up. Everything's been up. So it's okay. We're taking a little bit of a breather, but yeah, we're down 10% there. Big Deal Donuts. Catan, who is one of our regulars, what's up, Catan, is an Ethereum Ripple trying to get into the Swift game. We're offering RLUSD, which is Ripple's stablecoin. I know that they have a ton of partnerships with banks. I do think Chainlink is powering some of the banking systems, stablecoin, tokenized stock, sort of infrastructure there. So there might be a thesis on Chainlink to do well because of that. I don't know how that translates to the token price, but I do know that infrastructure is being used in some of the banking rails. Lone Sophos been to Sweden, so
let's go.
Not Norway, but Sweden.
Apparently, I'm Norwegian. Didn't know that.
I could have told you that.
Oh, okay.
Emmett says just went to Italy in November. Grumpy Mike rarely leaves the house. Yeah, I feel you.
Respect.
Yeah. So here we go. Which stable coins won't make the Genius Act? Which will? I don't know. That's I should dig into that. I'm not totally sure.
Yeah.
I don't know if it like my interpretation of that Genius Act was not that it was giving certain stable coins certain permission to exist. It was more of the framework for issuers to issue these stable coins, like what they need to follow, right? So I know a big one was they can't pass yield on. So the yield that these stablecoin issuers are generating, which is massive. That's how they make their money. They're not able to pass that on to like the holders.
Right.
So that's out not legal through this act. So I do know that was one big thing, and I think it just gives a framework for stable coins to kind of exist and be issued in the States. So we'll see how that plays out. Chainlink, I got to read up. Yeah, take a look at Chainlink. It's been around for a while. It's probably one of the more useful projects out there. Any coins that are heavy inside owned. Depends on what you mean by inside owned. So it's not like, it's kind of tough. One of the things that you can do is you can track wallets. And wallets are tracking wallets are kind of similar to how you would track maybe like insider shareholders or big institutions owning certain percentages of stock. So I have a couple platforms that I use for that. One's called Arkham. And Arkham is basically a data company, and it's called Arkham Intelligence. Let me see if I can get to it. And it basically just allows you to track and see wallets of certain tokens. That's one way you can track that and just see who's selling, who's buying. So, or kind of what's going on in that particular token.
Whale behavior.
Or it tracks Robin. So I see Robinhood's cold wallet here, right? So Robinhood has $4.8 billion worth of Ethereum on its platform, right? Binance, this beacon deposit contract that's staked, right? That's the staked Ethereum. So about $231 billion worth of Ethereum is locked in staking. So whatever percentage of that supply is, that's being staked. You can see Binance cold wallet here, Upbit's hot wallet. Let's see, Kraken. So you can view kind of what's being held on exchanges, where that flow is coming from. Is it being taken off exchange? Is it being moved on? A lot of people believe that or I guess like the theory is that when a lot of stuff flows on exchange, it's going to be sold and taken out of the system. When it's taken off exchange, it's kind of going out and on, doing DeFi activities, doing things that people believe like is bullish. So that's slightly different than how we look at traditional side of stuff, but you can track that. The whole thing's an open database. There are programs out here that allow you to do it. I'll drop this in the chat, so if you guys want to take a look, then you guys can do that. So let's see.
Bring your Visa card and leave Amex home. Interesting. Okay. Use your credit card for everything. If you need euros for anything, go to a local bank and pull money from an ATM. You get the best exchange rates that way. Thank you, Emmett. This is all good advice and much needed. Yeah, that'll be interesting. I'm excited. Dan, you've been to Europe, haven't you?
I have been to Europe. I've been to London. I've been to Munich. I've been to Zurich, Switzerland. And then I've been to Amsterdam.
Nice.
Yeah. And same.
All in the same trip?
Yep.
Okay.
Same thing. Actually, if you want to, because it's all Eurozone, you're not going to London, are you? You're not going to UK. It's all Eurozone. You go to the Chase Bank down here on, or really, you can go to the one down here on Michigan Ave, or any in the city, and they'll give you a really good exchange rate, and you could take the cash over for you if you want to do that like immediately.
Yeah, I don't know if I want to carry a lot of cash.
Don't buy it at like airports.
Yeah, good grief.
I'm sure they have. I'm sure.
Yeah, my son is there. Like my son is in Italy, so we're meeting in Norway.
Yeah.
But yeah, we'll see. We'll see. But thank you for all the advice, chat. I appreciate it. Let's spin the wheel.
Yeah, let's spin the wheel.
Are you ready?
Yeah.
All right. Oh, my mouse is stuck. All right. Spinning. Oh, Bitcoin. Right out of the gate. Here you go. Let's speed run it, Dan.
Digital gold.
It's too easy. Too easy. Give me a price prediction by the end of this year.
End of this year, End of this year, we'll touch 135.
Okay. It's kind of conservative, I think.
By the end of this year, we'll touch 135.
Touch it. Just tickle it. I want to hear what Chad has to say. Price predictions for Bitcoin.
Price predictions for Bitcoin.
Yeah.
What is yours?
I think we may touch 150
Okay.
by the end of the year.
Do you think it's like do you feel like this cycle has been a little bit different where the price movements have been a little bit more controlled?
Yeah.
Because don't you feel like, I just remember last cycle, and when I say last cycle, like that 2018 to 2022 kind of years, is like it just felt like, you know what I mean? It felt very, it was just volatile and like chaotic and
see, that's when I entered the space, or like really got involved. So it's like that's my conditioning now. I keep expecting that. I'm like, we're on the roller coaster. Like, let's go. And then I'm like, oh, it's just this choppy. You know, it's interesting. Solidation, a lot of that.
Yeah.
But I think with all this new clarity, I think we're going to see some big institutional moves that are just going to drive a lot. But we'll see what that means for, altcoins and everything. I'm optimistic. Primo, zero in the long run.
Tom Banjo, 68K. Okay.
It'd be interesting. I'd be buying a lot if it pulls back that far.
Yeah, so would I. Zero in the long run. Okay. That sounds like Cope. Primo, that sounds like Cope. I'm not going to lie. Edward, hey, what's up, Edward? Smart way to exchange before you go. Yep. Yeah.
Very cool. All right, spin it again.
Okay.
We got 15 minutes. Let's see if we can get through everything on the wheel. That would be aggressive. AVAX. I just used this chain today.
Okay. We have it on the platform, obviously.
All of these are on the platform.
I am looking at a yearly one-day chart, so let me.
I love that the, what is it? The scan, the base
Snow scan.
I love that it's called Snow Scan. That makes me happy.
So I guess I would say like a Gen 2 Layer 1 smart contracting platform that is EVM compatible but has something called, what is it, subnets?
I'm not super familiar with this one, so I'm going to lean a little bit more on you.
Yeah.
So this is EVM compatible, but it's not a layer 2?
No, it's a layer 1.
Interesting.
I believe. Yeah. Let's see. Yeah, it's a general purpose blockchain. General purpose layer 1 that has there's three different blockchains on the Avalanche network: the exchange chain, X chain, the contract chain, C chain, and the platform chain, P chain. So the exchange chain is the primary blockchain for asset creation and exchange, including AVAX, the native token. The contract chain, C chain, supports the creation and execution of smart contracts. And then the platform chain, P chain, manages a network of validators. And it's based, so it has its own virtual machine, but it's based on the Ethereum virtual machine. So all that means is it's compatible with Ethereum.
Interesting. And you can fund your Tasty Trade account with stablecoin.
On Avalanche.
Because I did that today.
Yeah.
So giddy up.
So, yes.
There we go. We spinning?
Found it. It launched in 2020, it seems like. Okay. Let's spin it.
Well done, Dan. Well done. Polkadot. Layer 0 infrastructure.
Dead.
Layer. Dead? How?
Polkadot?
Polkadot.
Who do you know is used Polkadot?
Well, because nobody's using it. It's just in use at all times. It's the layer 0 that's connecting different blockchains so they can communicate together. Damn, Dan.
I think that
harsh.
I don't think that is.
All right, we're spinning again.
Hold on.
Okay.
Let me
All right.
I just want to bring up the chart because I'm convinced.
As far as trading it goes, I mean, I haven't looked at the chart, but what it is that layer 0 infrastructure layer that's providing communication between different blockchains so that
Yes, okay.
it's an interoperability layer.
Pooled security. Yeah, so it is a layer 0 open source blockchain, allows multiple blockchains to connect and operate within itself, and share their unique features while pooling their security. The only reason why I have a negative bias on it is because there was a report that was published about the Polkadot treasury, and I think they had something like $500 million or some outrageous amount of money was just going toward like marketing events. And I don't know if it has any real adoption. Like, I don't know any applications on.
Cite your source, Dan. Where was this from?
This was on Twitter like over months ago. So I've never.
You got influenced and you didn't check the source?
But it's kind of like one of those things. Like, you use apps on Solana. You obviously use applications on Ethereum, Bitcoin, some of these other layer 2s. Who's using Polkadot?
Well, that's what I mean. Like, it's a layer 0, so it's not like a retail. We're not using it.
But I know, but like,
I look at it as like a ComEd or an energy company that like I'm paying a bill, and I'm flipping light switches and I'm using, but I'm not thinking about the brand ever.
Okay,
that's kind of how I look at it.
There's no value to that token. There's no value accrual to the token. But we got it. If you want it, we got it.
Yeah.
Okay.
All right. USDC, stablecoin, Circle.
Issued by Circle. What is Circle's stock at?
Yeah, let's look.
Did it crash? Oh, it's in $200.
Stretch your chart out a little bit there.
I don't know why it's.
You're all squished. There we go.
All right, it's kind of pulled back a little bit.
Okay.
It's not bad.
Do you own any Circle?
I don't. I do eventually want to own it. Mm-hmm. I have a rule against trading IPOs.
Yeah.
So, does anyone know how high the price of tulips reached in the 1630s? That's a good question.
That's tickling a memory of something because my daughter did a report on tulips and this came up, but we're talking like years ago, so random. Let's see, Big Deal Donuts, what drives this? Circle. Is the question, so Circle is the company behind USDC, but I feel like from a front-facing perspective, USDC is more associated with Coinbase, but it's actually Circle that, what's the word? Like
the issuer.
Issuer, thank you.
Circle's the issuer. Mm-hmm. They're the ones that they provide services to platforms that want to connect to stable USDC specifically. They also mint or create the token on chain and then have the collateral in a bank account wherever. I think it's with Cantor Fitzgerald or something. Maybe that's Tether. But anyway, they're the issuer. They're the stablecoin issuer. It's not a bank. It's not, they don't have a banking
So like
license.
if I give them one of my dollars, they're going to give me a USDC token. They're going to take my dollar, put it somewhere so that it is backed 1-to-1. And then if I want my dollar back, whoosh, I get it and they burn that token. So it's a 1-to-1 pegged to the US dollar.
Didn't Circle buy from Coinbase? So Catan, I believe that Coinbase owns 40% of Circle, or don't quote me on the percentage. They own.
They share their profits. So I think it's 40 or 50% of Circle's profits go to Coinbase.
Yes. Yeah.
So that's why when this IPO happened, people were like, oh my gosh, it's so overvalued, because if you go to the fundamental analysis on the business, it's like most of their profits are going to Coinbase. Why is this stock going up so much? But people are viewing it as more of like a demand for exposure to crypto.
Right.
and stable coins. And so Circle was just one of the first and only to offer that exposure.
Yeah.
So that's why we're looking at the stock price. But I mean, that's a big business, stable coins.
Huge. Yeah. Do you guys feel that stablecoins can literally take over payments for homes, et cetera? Imagine Rocket, Carvana, et cetera, using this. I mean, I do.
Absolutely.
I do. I
am going to Europe. I wish I could use stablecoins to just fund my travel.
Yeah, I mean, I don't know if you're gonna like consciously know that you're using them,
right?
But it will drive a lot of the the back end stuff. You guys have talked about it. I forget who it was, if it was Canton or someone else. You guys have talked about it before, using Swift or whatever, LIBOR, or some of these like settlements take days, cross border takes days. It's very disjointed. So I definitely do feel like it takes over as far as infrastructure goes, with how payments work and how platforms are connected. So yeah, certainly believe that it will take over in some capacity.
Primo's got a great question. 1 million American dollars or 10 Bitcoins. Go. I'm taking the 10 Bitcoin all day.
10 Bitcoins.
10 Bitcoin, please.
Yes.
And you can use Bitcoin as collateral to buy a house now, and get your Bitcoin loans. So yeah, Bitcoin. Spinning. Ooh, what is it? Oh, Litecoin. Boomer coin.
It is a boomer coin. Created by a guy named Charlie Lee in 2017 to maybe it was even earlier. It might have been 2011. To be a cheaper Bitcoin, or
lighter, like
faster, rather.
Faster,
it's not cheaper, but faster. Peer-to-peer currency created by Charlie Lee, based on the Bitcoin protocol, but differs in terms of the hashing algorithm and its max supply. Yeah. There will be 84 million Litecoins that can never be minted or mined, which is 4 times more than the Bitcoin's max supply. Yeah.
Interesting that it never really took off. I remember when we were looking at this before, when I brought up the little Southport buses, the chain, you can view how the chains are, and Litecoin is just no buses. Nothing's happening. All right.
It's one of these things, like, it's just very early. 2000.
Sui.
Ooh.
We need to agree on how we're saying that.
Sui. Yeah.
Like chop suey.
Yeah.
Sui.
Yeah.
Sui. Okay. How are we saying it? I want to hear from chat. Like sui? How do you say it in chat? But all right, let's talk about it.
So that is what I consider a Gen 3 general purpose layer 1 blockchain. It has basically the big difference is that it has a different programming language, and that programming language is safer and faster and easier to program in than like Ethereum's or Solana's. And because of that, you can create unique programs and more scalable applications. This project was spun out of Facebook, Meta's blockchain unit. So Facebook had a stablecoin and blockchain unit that they were trying to launch that got shut down in 2019. So they spun this out, and this Move programming language is what they created. Facebook created Move programming, or the unit, and Sui is one of them that uses this. So
love that.
Yeah.
Well done, Dan. We got Lone Sofa. Sui. Okay. Yep. Sui. Phonics. Aave. How do we feel about Aave, Dan?
That's a good one. That is a DeFi protocol. It is a borrow-lend platform. It allows you to deposit ETH tokens, whatever, and borrow against it. It makes a lot of money. This is a real application that people use.
Can you pull up the chart?
Yes, I can. Aave.
Ryan's put on some good Aave trades lately.
Yeah, actually, should we take a look at the follow trade? some point.
Yeah.
Where is that? Here it is.
Pull up Ryan. He, I actually duplicated his trades when he was messing with Ave, and I was like, hey, thanks. We both made a little bit of money. It was a few weeks ago, though. I think
So
he
Ryan
exited some positions in the last couple of days.
Here's his Ave trade. Bought. What do you do? Buy at 288. Was bought at 264, sold at 292. It's pretty good. But yeah, it's a DeFi protocol. People use it, makes a lot of money. They have their own stablecoin as well. It's called Ghost. GHO is the ticker. If you want to look that up, it's their own native stablecoin. And all I know is that Ave means ghost in Swedish.
Well done.
So
we are out of time. How did that happen? That was so fast. All right. Go ahead.
If anybody wants to email us, ask questions, stablecoin funding is now live. Please check that out. Let us know if you have any issues with it or what you think about it. Give us recommendations. We're making improvements to the platform all the time, and we'd love to hear from you. Shelly's going away, so we want to give Shelly her last chat. You might never see her again. She might just stay over there.
No, I'm coming back. I'll be back. It'll just be 3 weeks, which feels like a very long time, especially in crypto. So thank you all for being here. We appreciate all of you. And Ryan will be back on Monday for the Tasty Crypto Show. But we will be on Friday with Beans. So I'm not gone yet.
Okay.
Come hang out with us. I think we're going to do a lot on ETH since it's next week is ETH's 10th birthday. So the big 10. Yeah, so we'll see you Friday.
Yep.
Thank you, Lone Sophos. Hope to see you Friday. Otherwise, if I don't see you, I'll be back in a few weeks. Can't wait. But thank you all for being here.
Thank you. See you guys. Peace.
Peace.